Have you ever just felt drowned in jargon? Where even simple stuff seems, well, deliberately complicated.
Oh, absolutely.
Happens everywhere, right? Tech, science, but especially maybe finance. It often feels like clarity just gets lost in the shuffle.
It really does. There's almost this protective layer built around investing sometimes, makes it feel
Yeah.
intimidating.
Yeah, exactly.
Oh,
But what if understanding something like, say, how stocks behave could actually be boiled down to just a few basic ideas?
no, that's an interesting thought.
Well, today that's exactly what we're doing. A deep dive into the intriguing, maybe surprisingly predictable moods a stock goes through.
Moods, I like that.
Yeah.
Huh.
So we're going to unpack these phases, look at what they actually mean in the real world, and then uncover a remarkably straightforward strategy for navigating the market. One that cuts through all that noise,
Yeah,
ditches the confusing finance talk.
sounds good.
Our main source for this is a really insightful piece from the Momentum Investing Club called Three Stages of a Stock. Okay, let's unpack this.
Yeah, let's do it. And it's so important, I think, to strip away that perceived complexity you mentioned. The real power for you listening is getting clear, actionable insights.
Right.
Things you can actually use to understand stock behavior, not just uh, repeat fancy terms. You should feel informed, not swamped by data.
Absolutely. Couldn't agree more. So let's dive into the core idea here. The source starts with this pretty striking comparison. It says something like, unlike human emotions, which can, swing wildly in a day, a stock goes through only three moods in its entire lifetime. Three. Just three phases. It sounds almost too simple.
It does, a little bit. But maybe that's the point.
Yeah.
It grounds something that often feels chaotic in a framework that's, well, actually pretty understandable.
Hmm.
You see, the stock market, despite, millions of people, trillions of dollars,
Hmm.
it fundamentally moves in these kinds of simple shifts. It's like the market's underlying rhythm.
All right, so what are these three magic phases? Let's start with number one, the bullish phase. I think most people kind of get this one, right? The green light period.
Yeah, the good times.
When a stock is generally heading upwards sustainably, the source calls it the everyone wants it stage. The company's getting positive buzz, lots of attention.
Exactly. It's that feeling when maybe a company hits its earnings again or there's a breakthrough product, and suddenly the stock's just e- exciting.
Yeah.
And crucially, it isn't just one good day. It's a sustained period where, generally, buyers are more eager than sellers. The company's story and its market performance kind of feed each other, creating this positive loop.
A self-reinforcing thing.
Right. The rising price pulls in more interest,
Yeah.
which can push the price higher still.
Okay, makes sense. But then inevitably, phase two, the bearish phase.
The red light.
Yeah, the opposite. The stock's on a sustained downward trend. The source puts it quite vividly, saying it's when nobody wants to talk about it and suddenly all the YouTube videos recommending it are gone.
Uh-huh. Yeah, that silence is deafening sometimes.
It is. It's that uncomfortable feeling, Maybe you should have sold earlier. It's just the selling pressure takes over.
And this is where market psychology really kicks in hard. In a bearish phase, bad news, or sometimes just a shift in how investors feel, can start that downward spiral.
Fear takes hold.
Exactly. People start selling, prices drop, which makes more people sell. It's a period often marked by fear, sometimes even panic or capitulation. And even really solid companies can hit a bearish phase sometimes, maybe because of the wider market or just a temporary issue.
Right, it's not always about the company itself. Okay, so bullish is up, bearish is down. What's the third one?
The sideways phase.
Ah, the white light, as
Yeah.
the source puts it, just there.
Basically, yeah. The stock is doing nothing, neither rising nor falling, just kind of flatlining.
No excitement, no panic, just, yeah, like watching paint dry. But it's your money just sitting there.
That's a great way to put it. The sideways phase, sometimes called consolidation or a trading range, it's when the buyers and sellers are pretty much balanced out.
Okay.
So you get this period of relative stability, but there's no real trend, up or down.
Mm-hmm.
And what's really fascinating here, I think, is how universal these three phases are. The source really stresses this point.
That it applies to everything.
Every single stock, doesn't matter if it's a huge global company like, say, Microsoft,
Mm-hmm.
or a small startup. Doesn't matter if it's on the NYSE or, a regional Indian exchange. They all dance between these three states.
So, like Bajaj Finance or Reliance, as mentioned in the source, they show these same patterns.
Precisely. Over time, you can see them clearly. Now, some stocks might cycle through these phases pretty quickly. Others might linger in one for ages.
Right.
But the key takeaway, the fundamental market truth, is that No stock can permanently stay in one phase. Eventually it moves on. It's just an unavoidable cycle.
Okay, so 3 simple phases. But they have real consequences, right? Especially when a stock isn't in that nice bullish
Oh,
phase.
absolutely. Big consequences.
The source really focuses on 2 critical types of losses here. Things maybe casual investors don't always think about enough. First, the obvious one. You lose capital in bearish phases.
Yep. The direct hit.
Your money literally shrinks. It hurts, you can measure it, it's what everyone thinks of as losing money in stocks. It grabs your attention.
And it's critical because it directly cuts down your principal amount. If you start with $100 and lose 20%, you're at $80.
Right.
Now, just to get back to that original $100, you don't need a 20% gain anymore. You actually need a 25% gain from $80. That's the tough math of losing capital. Recovery is always a steeper hill to climb.
Ouch. Okay, that's capital loss. But then there's the second loss, which feels sneakier.
Mm-hmm.
You lose time in sideways phases.
Yes. This one is so important.
Your money isn't disappearing, maybe, but it's just sitting there, doing nothing, not growing, not compounding, just stagnant.
Like having cash under the mattress almost in investing terms.
Exactly, when it could be working for you. And everyone says time is your biggest asset in investing, right?
It really is. And if we connect this to the bigger picture, well, both these losses, losing capital and losing time, are incredibly damaging to your long-term compounding journey.
Explain that link a bit more. Why is time loss so bad?
Well, compounding is like that snowball rolling downhill, right? It picks up more snow, gets bigger, faster, and faster.
Uh-huh.
When you lose capital in a bearish phase, your snowball shrinks. You got less to compound from. Simple as that. But when you lose time in a sideways phase, your snowball just stops rolling.
Ah, it's not growing at all.
Exactly. It's sitting still, maybe even melting a little with inflation, while other snowballs are getting bigger. Both things wreck your potential for that exponential long-term growth. It's not just about not losing money. It's about making sure your money's actively working. If it's idle, you're effectively falling behind.
Okay, that makes sense. So losing capital hurts now, losing time hurts later, potentially even more. That sounds, well, like a minefield for investors.
It can feel like it sometimes, yeah.
Does the source offer a way through this? A strategy? Or is it just try not to be in the wrong phase?
No, it definitely offers a path, and it's actually remarkably straightforward. The core idea, the key to winning, as they put it, stick with stocks in their bullish phase.
Just stick with the winners. Focus on the growth periods.
Essentially, yes. Leverage those times when the wind is actually at the stock's back.
Okay, but that sounds easy to say, maybe harder to do. How do we know it's a real bullish phase and not just like a couple good days, a false start?
Right. That's the critical question. Because chasing every little spike is a classic mistake.
Yeah, I've done that.
We all have. And the source is clear. It's not about constant green candles one after another. That's impossible, like you said. It's about ensuring the overall trend needs to be upwards. But yeah, how do you gauge that accurately?
So what's the tool?
And this is where momentum comes in. It's presented as the crucial identifier.
Momentum.
The source puts it super simply. Momentum helps you measure a stock's bullish strength. That's it.
Yeah.
Think of it like a speedometer for how strongly a stock is moving up.
So higher momentum means stronger bullish phase.
Exactly. Stronger the momentum score of a stock, stronger is its bullish phase. And importantly, this isn't just about a stock jumping 5% one morning. That's just noise, volatility.
Right, not a trend.
Not necessarily. The real power of momentum, the insight, is that it identifies sustained trends. A lot of people try to buy the dip or chase spikes.
Guilty again.
Huh. Well, momentum focuses you on what's actually happening. Stocks that are moving tend to keep moving. For a while, at least, to show high momentum, a stock needs to consistently show up moves across various time frames.
Ah, so consistency across time is the key.
That's it. That consistency is what allows momentum to act like a filter. It helps filter out the stocks in their bullish phase from the entire stock universe, pointing you toward the ones that are genuinely sustainably trending upwards.
So it helps you find the real strength, not just the temporary bursts, cuts the noise.
Precisely. It's a fundamental principle, really.
And this whole approach really seems to champion, well, simplicity. So what does this mean for, for you listening? If you just want to understand the market, maybe do okay without needing a PhD in finance.
Well, the author argues pretty convincingly, I think, that a system that prioritizes holding stocks going up and not relying on many other jargons has proven to be a winner over a number of years.
Wow. So simple can actually win.
It really resonates with that idea that investing is simple if one wants it to be. It kind of pushes back against the notion that you need to master hundreds of finance bro words, as they put it, just to understand or succeed.
Which is refreshing, isn't it?
It really is. How often do you find advice that's just clear, direct, focused on something you can actually do, instead of just burying you in technical stuff?
Not often enough.
It underlines that the core ideas of good investing, they don't have to be some big secret wrapped in complex theories. You don't need a crystal ball. You just need a way to see what's already working.
Okay, so let's just quickly recap this deep dive then. We've looked at the three basic moods of a stock. Bullish going up, bearish going down, and sideways going nowhere.
The good, the bad, and the boring.
Huh, exactly. And we learned that avoiding the bearish phase saves your capital. And avoiding the boring, the sideways phase saves your precious time.
Both absolutely vital for long-term growth, for compounding.
Right. And maybe the biggest takeaway, focusing on stocks that are actually in that sustained bullish phase, using momentum as our guide to confirm it, is presented as a simple, proven strategy.
Yeah, a way to cut through the complexity.
It really brings it back to basics, doesn't it? Effective investing doesn't need to be some ridiculously complicated puzzle. Just by understanding these three stages and using a tool like momentum, you, our listener, have a powerful shortcut, a way to be more informed, more effective when you're trying to make sense of all the financial noise out there.
Absolutely. And maybe that leads to one final thought for you to chew on.
Go on.
It's something that seems as complex as the stock market can actually be broken down into just 3 moods and a pretty simple, effective strategy like focusing on momentum. Well, what other areas of our lives might we be overcomplicating?
Interesting point.
Maybe there are other places where a clearer, more focused understanding, cutting through the jargon and complexity, could lead to surprising clarity, maybe even more success, whether it's work, health, relationships, anywhere. We assume things have to be convoluted.
So simplicity might be powerful in more places than just investing.
It's just a thought. But it's a powerful reminder, isn't it? Often the most effective solutions, the clearest paths, are actually the simplest ones. Something to think about.